Hello everyone. Today, let's look into APL Apollo Tubes Limited, one of India's biggest makers of steel tubes and pipes used in construction, furniture, and infrastructure. Here is what their financial story tells us. If you look at sales, 10 years ago, APL Apollo made 2,497 crores in sales. This year, that's grown to 20,885 crores. That is 21% growth every year on average over a decade. Strong and steady. The last 5 years saw 22% yearly growth, and even the recent year grew by 14.19%. So, what's impressive is the consistent upward trend, no major crashes or wild swings. This is steady growth, not erratic or cyclical like some steel companies. And expenses climbed from 2,332 crores to 19,616 crores this year. The biggest cost is material expenses, about 82 to 89% of total cost, since they buy steel and convert it into tubes. Manufacturing, employee, and other costs are small, 2 to 4% each. APL Apollo keeps cost well controlled and moving in line with sales growth. Operating profit grew from 165 crores to 1,269 crores now. The operating margin is 6%. So, for every 100 rupees in sales, 6 rupees is left after direct cost. Margins have stayed steady between 5 to 9% over the years, showing consistent efficiency. Other income was 97 crores last year, mostly from investments and side operations. It's a nice add-on, but not the main profit driver. Interest costs are 139 crores per year, reflecting some borrowing for expansion. Depreciation: the cost of machinery wearing out is 209 crores annually, normal for a manufacturing business. If you look at net profit jumped from 59 crores 10 years ago to 801 crores this year. That is 28% annual growth over a decade, faster than sales growth, showing improving efficiency. Even the recent years saw 6% profit growth. EPS rose from 2.52 rupees to 28.87 rupees this year, a huge win for long-term shareholders. Return on equity is 19%. Return on capital employed is 22.4%, both excellent for a steel tubes manufacturer. Dividend payout is 21% of profits, with a yield of 0.34%. Modest, but regular income for shareholders. So, APL Apollo shows steady growth. Sales and profits climb year after year without major ups and downs. Unlike cyclical steel companies that boom and bust with commodity prices, APL Apollo's value-added products give it more predictable demand and pricing power. So, overall, APL Apollo is a rare example of steady, predictable growth in the steel sector. Strong demand for infrastructure and construction keeps sales rising. Costs are controlled, profits grow faster than sales, and shareholders get decent returns plus regular dividends. If you want a steel company without the wild cyclical swings, APL Apollo delivers consistent performance year after year. If this breakdown was useful, subscribe to Wealth Growth Club and tell me which company you want next.